Banks, certified financial planning professional, small business coach, and investor, coming to you from Austin, Texas. Thank you so much for listening or watching the show. I'm so excited you're here and joining me for another week of financial therapy. Before we get started, please don't forget to like us, subscribe, give us a hopefully great review so you don't miss a thing. So today's episode is a good one. It is called The Instant Investor. The Instant Investor. And for those of you who are in the know, the Intelligent Investor, Benjamin Graham, is a long, widely held, loved book from a guru that teaches how to become intelligent about investing your money. But a lot of us, including many clients that I have, and that I've coached over the years, don't really want to be intelligent investors. They want to be instant investors. And so I came up with a few kind of areas that you might look into if you're looking to just kind of move your investment activities forward, but you don't kind of know where to start. And that's a lot of people. A lot of people are not necessarily comfortable with taking a whole lot of risk, so they don't want to invest in a single stock. They might not want to invest in something like crypto that can be very volatile. And right now the market is kind of in an interesting spot. It's very dominant. AI is very dominant in the market right now. Anything tech related is very dominant right now. And so you just might not be comfortable trying to figure out where to put your dollars and make them work for you. We had an episode on making your money work for you. And so if you're trying to find investments that will kind of meet your needs as an investor who wants to make that money start earning some good interest, but you're not necessarily comfortable choosing your own individual stocks, you might not know where to start. You might be willing to pay someone to actively manage your money, and I'm going to throw out a few ways that you can kind of dip your toe into taking some financial risks, hopefully without a whole lot of intervention from outside, because those interventions cost money. Anytime you ask for advice from someone or have some sort of coaching planning session, and certainly if you're getting your money actively managed, that costs money. So here are some ways, some things to look into that I think will give you guys some opportunity to start making that money working for you. But still with that kind of set it and forget it attitude that I think so many people are kind of really needing when it comes to their personal finance, especially in the investment space. So I'm going to have a little disclaimer here that I am not telling you to put your money in any of these things. I am telling you to research and become informed about these areas, because these areas are ways that you can take a little more financial risk in kind of a comfy environment. So the first instant investing tool is target date funds, or life cycle funds. It basically, what they do is they are used for retirement savings. They automatically adjust their mix of what's in their holdings based on the year you plan to retire. So these are the funds that say such and such fund 2045, because it's targeting the asset mix between equities and fixed income to basically tailor itself and adjust itself as you get closer to retirement. So as you get closer to retirement, these funds will take less and less of your dollars out of or put less and less of your dollars into equity. It'll take those dollars out and shift them over to a fixed income position, or several fixed income positions. So the idea with these funds is that they're simple to choose. You just pick the fund tied to the date when you want to retire, and that's your target year. So I want to like give a little bit of caution here, because it is still important with these target date funds to think about fees, how the fund does allocate your assets. So if they are really heavy into equity and you aren't comfortable with that level of risk, you can actually invest in a different target date year that makes it a more comfortable strategy for you. So for instance, if you were going to retire in 2045, but you wanted to be a little more aggressive with your investments, maybe you would invest your money in a 2050 target date fund, because that means you would stay in equity positions for a little bit longer on the front end of that investment. If you were not as comfortable taking risks, maybe you would set that target date at 2040, and that would remove you more quickly from some of those heavier risk equities and into those fixed positions allocations more quickly. So I hope that that kind of makes sense. Target date funds do have pros and cons. They do have a huge tie to whatever organization is housing that target date fund. So whether it's Fidelity or Vanguard or T. Rowe Price, wherever you have those retirement funds, you need to understand that those funds are exclusive to that vendor. And so you're buying a fund of funds from a specific place. And so you obviously, like any organization, want to do your due diligence with that. You're also buying a mix of funds. It's like a fund of funds. And so you might have some higher expense ratios, some higher fees. Some of them might be actively managed, some of them might not be. And so because you're buying a fund of funds, your fees or your expense ratios, your expenses within that fund can add up. So you want to make sure that you're checking what you're actually paying to access that target date fund. And as I mentioned before, you do want to pay attention to the asset mix. So how aggressive are these weighted toward equity versus fixed income? You want to do your due diligence and take a look at that before you move into that investment. Okay, so first way to be an instant investor is to invest in some target date funds. Second way is to look at ETFs. So ETFs, exchange traded funds, are investment funds that trade on stock exchanges. They trade much like regular stocks. So you could buy like one share of an ETF, which is really beneficial because it makes it very flexible to get into this space. There are, unlike with target date funds, there are very few minimums for entry into these sort of things. And you can still follow a pretty passive strategy, but also get some of that return in exchange for your risk. The other side of taking these risks is getting some reward. And so ETFs do allow you to kind of get in on the reward with a more diversified risk. So these really can track just about anything, industries, indices, commodities, bonds, other asset classes. So if you're looking at tracking an industry, I think it's really important with ETFs to understand where they're weighted. So I'll give you a good example. So if you are invested in a communications ETF, that might have 300 different communications stocks inside of that ETF. But you want to take a look at the top holdings for that ETF, because the top 10 holdings, of those top 10, there might be one stock that's 23% of the entire, or 25% or 30% of all of the holdings within that ETF. And I mentioned 23%, it was a little bit of a Freudian slip, because I was looking the other day at one of my investments, and one of the ETFs that I'm invested in, one stock carries 23% of the weight for the entirety of that ETF. And so it's not a huge deal, but you want to check those top holdings to see just how diversified you actually are when you're buying into that ETF. It's very typical for if there's a company or a vendor that is dominant in that industry for that to kind of rise to the top. And you want to be sure that if you are heavily invested in that ETF and you're expecting some level of diversification, that you are taking into account the fact that it might be very heavily weighted in one way or another. Okay. And the very last way to instantly invest is through index funds. So index funds, I know a lot of people have heard about. They are a type of mutual fund or an exchange-traded fund that is designed to track a specific market index, like the S&P 500, NASDAQ 100, Russell 2000, all of those things are indexes. And so ETFs can track indexes as well. As industries, but index funds are specifically designed to track indexes. And so these are another passively managed investment, but they still require some level of skin in the game investment from you as far as doing your due diligence. So you want to look again at expense ratios. You want to look again at how much it actually takes to invest in an index fund. Dissimilar from ETFs, you can't always buy a single share, and so it may require some more initial investment of your actual dollars. And there's also no timing of your trade. So you can't trade it on the stock market kind of like an ETF does with alongside or parallel to a regular stock. So it's a little bit different to get entry into index funds, but they can still be worth it. They do have generally, along with ETFs, pretty low expense ratios. And so that means paying a lot less management fees, but you're still getting the diversification and you're still also getting that entry point into getting some get comfort with risk, but without putting all of your dollars on black, so to speak. So the thing to think about with index funds also is that because it tracks an index's performance, you're going to be obviously heavily weighted towards that index. So if it's an index like a NASDAQ index that might be a little more up and down than your typical S&P 500, especially if it's NASDAQ 100, so it's based on 100 stocks, or it's Dow Jones, where it's based on 30-something stocks, it's not going to be quite as diversified as you might expect. So it's really important for you to, if you're going to buy into an index fund, understand the index that it is meant to track, because you don't want to be seeing the ups and downs of the market and wondering why that's happening. It's happening because that's what's happening on the index, and it's meant to mirror what's going on with that index. So again, I want to make sure that everybody kind of thinks about these three potential tools for investing and kind of getting more comfortable with risk, and hopefully takes a little bit of worry off of your plate for what do I do with my money? I have this to invest, or I'm putting money away every month, but I don't want it to just be sitting there in savings. How do I take that first step and become an instant investor? So first thing was target date funds or life cycle funds that track along with equity management and allocation between equity and fixed income funds through to your retirement date. The second thing is ETFs, which trade on a specific commodity or market or industry. And the final thing was index funds that track a specific index. Each of these are great tools to investigate and explore, do your own due diligence on. Personal finance is personal, so all of these options are just options for you. And if you want to become an instant investor, they are great ways to start your research on how to do that. So thanks so much for joining me for this episode. I will be back next week with another one.